Hi, I'm Bill Carmody, and I'm the Marketing Whisperer. And today on the program, I have Peter Mallouk, who is the Chief Investment Officer and President of Creative Planning. Hey, Peter, how you doing?
Great. It's good to be with you.
Oh my God. I'm so happy to see you actually face to face. I first heard about your company in Tony Robbins' book, Money Master the Game, and then again in Unshakable. And I think there's so many things I just want to jump into. But before I do, I just want to say one thing. I'm on a mission to help 1 million people get $1 million in their accounts because I feel like that's what the definition of middle class is today. It's not even about being rich anymore. It's about how do you actually retire at some point in the future. So today when we talk about all these things, I want to keep that in mind that the audience that I'm talking to, I'm trying to give them as much insight and advice as they can to make sure they're making the right investment decisions so that they can build wealth and not have it taken away from them. All right, fair enough?
Sounds like a great focus. Perfect.
So let's start off with just a fiduciary. I think this is one of the most important concepts that people don't fully appreciate. I had a financial advisor at Merrill Lynch for many years, and I thought he did really good, and I looked at my investments portfolio, everything looked good to me, but I realized after the fact that not only was he saying he was a fiduciary, but he was also a broker-dealer, and I didn't realize the difference between the two. So maybe you can explain what is a fiduciary and where is sometimes a fiduciary not a fiduciary?
Yeah, this is, an incredibly messy situation, and 99% of people are confused about it because they absolutely should be. Basically, I think the way I'd start is you can start with maybe two camps. One camp is brokers covered by one set of rules, and other is fiduciaries, independent advisors covered by another. A broker by law has to do things for their client that are suitable.
Yes.
So imagine going to a restaurant and having a suitable meal or getting suitable health care. And an independent advisor, as a fiduciary, has to act in their client's best interests. They have to do for the client what they would do for themselves. So pick the best meal, give the best health care. So, everybody choosing between those two legal standards would always go to a fiduciary.
Right.
And every time they go to Congress and try to pass a law to make everybody a fiduciary, brokerage houses block the rule, because if you're a fiduciary, all of a sudden, maybe you can't use your own product. Maybe you can't get a kickback on a mutual fund. Maybe you can't be in the higher fee fund that does the exact same thing. And so you would become less profitable on a per client basis. So about 90% of financial advisors, everyone calls themselves a financial advisor, financial planner, money manager, wealth manager. About 90% of them are brokers, and about 10% of them are independent advisors. So I just start with that framework.
Yeah. Well, and again, I think what's important that you've mentioned is that this idea that the lobbying effort has helped sort of obfuscate this definition, because to your point, everybody would choose that fiduciary standard if it was something that was not only readily available, but actually transparent, where people could actually
Right.
see when are you a fiduciary and when are you a broker dealer. So, and having that obfuscation, it basically stops people from really understanding what it is that they're hiring and who they're talking to in any particular investment decision. And that's really important.
Yeah, what you're touching on is what's even more confusing. So first of all, nobody even understands what we already talked about, which is this idea that brokers are held to a different standard than independent advisors, and which, by the way, is unique to the United States. In the United Kingdom, all financial advisors have to be fiduciaries. In Australia, all financial advisors have to be fiduciaries, and it's unique to this profession. In the United States, lawyers are fiduciaries. Your CPA is a fiduciary. Your doctor is a fiduciary. They're all held to this best interests of their patient-client standard. It's unique to financial advisors in the United States. And what's happened is you've had people leave the brokerage world and move over to the independent world. But then what they do is they also set up or work with a broker-dealer at the same time. So what you're talking about is you might go to an advisor, and now it's possible to go to a brokerage house like Merrill Lynch that you referenced, or to go to an independent advisor. But the brokerage house, that advisor is sometimes a fiduciary, and you can go to the independent advisor who is sometimes a broker. That's, in many cases, when an independent advisor is doing it, it's dual registration. They register as an independent advisor and as a broker. So they're sitting with you and you say, "Are you a fiduciary?" And they say, "Well, yes, I am," because they are, when they are acting under the independent advisor setup, under their registered investment advisor setup. But when they're acting as a broker under the broker dealer, They're not,
And if our audience isn't totally confused by now, that's the point, right? I mean, this is the whole thing. I mean, I went back and looked, there was a 50-page disclosure document which outlines everything you said in nice, easy to read terms, not legal terms, right? So basically, you have the lawyers taking all this information, and if it wasn't complex enough in plain English, now they're basically using legal terminology that most people don't understand to very purposely say, here's what we do and don't do, and it's all there if you want to read the 50 pages of legalese that most people don't read, and so they protect their ass. But really, when it comes down to it, like, the question just comes down to, do you have my best interest at heart, and are you performing at a fiduciary standard where every time I talk to you, you're putting my needs above your firm's? And if the answer is sometimes, that scares the hell out of me.
That's right. I think the thing that your viewers, that middle class American you're talking about, we're trying to get them to $1 million. First thing you need is an advisor that has to act in your best interest all the time. If you're going to have an advisor, I mean, at least demand that advisor has to act in your best interest all the time. And so you want somebody who is not registered with a broker dealer. So one way to figure that out is to basically ask them if they're holding the Series 7. If they are, they're a broker, and they're registered as a broker. They might also be independent, but now we're in that area where they can act in both ways. You can also go to a website, FINRA's website, FINRA, and type in the advisor. If the advisor is active there, then they're also a broker.
So let's talk about creative planning for a second, because one of the most important things here is the company you keep. So one of the reasons that I'm so interested in creative planning is you are pure fiduciaries. You don't have that conflict. The only way you're making money with your clients is the actual percent of their portfolio that they agree to right up front. So that's very simplistic, very straightforward. Yeah. But now, above and beyond that, tell me a little bit about the talent and the team that you've created, because I think that's a really important for people to understand.
Yeah, and I like that you touched on how we have our relationship with clients. It's a percentage of what we're managing, and it doesn't change no matter what investment it is. So if it's an alternative investment that's very complex, if it's a simple stock or exchange traded fund, the fee is neutral. So that client knows we're always going and looking for the very best thing we can find. We don't own any of our own products. We don't also have a dual registration. We don't collect revenue sharing from third parties. And so the only fee is the one you mentioned. And that's really the only way to work with an advisor. You either pay them a percentage of what you're managing that never changes, or you pay them an hourly fee, and that's it.
Right.
And you want to make sure they're not making money on the investments any other way. But you were speaking to talent, I think was your question before I got. And I think talent is probably the number one thing inside of a firm once you eliminate the conflict. I mean, we can't get anywhere if there's a conflict. So you can have somebody who's amazing, but if they make more money, if you do A versus B, you're going to get A. That's just how it is. Compensation drives behavior, as we all know. So we've got to make sure we've got somebody who's a fiduciary and has to act in our best interest. But after that, we're looking for talent. And at creative planning, we're always looking for that in a variety of ways. And number one, we want to see credentials. I mean, so on our team, if someone's working with an advisor, we want that team to have somebody who is a CPA, somebody who is a CFP, certified financial planner, a practitioner, someone who is an estate attorney, and a team like that that's got education and credentials and is used to working with a client like you. So if you've got $100 million or you've got $500,000 or $100,000, you want to be working with a group of advisors that group of advisors is focused on people like you all the time. You don't want to be the outlier with that set of advisors.
Now, you just a couple years ago, you wrote a book called The 5 Mistakes That Every Investor Makes. And so I'm curious if you could just sort of give some highlights there, because I think that's important for people to understand that if every investor makes the same 5 mistakes, what are those 5 mistakes and sort of what is it that they should be doing differently? And I know that you have a whole book on that topic, but maybe like the short version and sort of give me the sound bite.
I'll touch on a few of them. I won't make everyone listen to all 5, but I would say that, the big one's market timing. And a lot of people go, oh, I don't market time, because they say, oh, I'm not taking all of my money out of the market and then waiting and putting it all back in. But that's not market timing. That's market timing, but that's not how most people do it. Most people go, oh, I got a bonus, but I'll wait for the tax bill to pass. Or I got an inheritance, but I'll wait for this thing with North Korea to settle down. And that's market timing. And you basically just have to have this, hey, I believe in markets over the long run. I'm going to invest all the time. But let's take the worst, most unlucky investor in the world. and he invested the day before the market started collapsing in '08,
Right.
or even in '07 when it was at its high at the end of the year, and we're at 14,000 whatever. That investor, if he went 100% all in on the worst day you could go in the last 80 years, last month doubled their money, okay, with dividends up over 100%. So it's very, very difficult over the long run to lose money, especially in a diversified portfolio. And a lot of people point to the lost decade of 2000, 2010. S&P 500 earned zero over that decade. But if you were invested in international emerging markets and bonds, all of those were up a lot. So you couldn't even lose money that decade. So the market timer really hurts themselves a lot. And I mean, unfortunately, with how politicized the country's become, a lot of people went to cash during the Obama administration. A lot of people went to cash right when Trump got elected. And the president doesn't drive the markets as much as people think. So that mistake to me is the biggest one. I mean, because we all know somebody who says, oh, I lost everything after '08, '09, or I had to restart after 9/11, or I had to restart after the tech bubble. Well, explain to me how that happened, because the market has gone on new highs after all those things. The only way that happens is you market timed or you have an incompetent advisor. Those are the only way.
Well, and one of the things that's really important as I hear this is also this idea of sort of people are talking about the market being overvalued, and people are talking about, what's going on with tax cuts relative to the Trump administration and all things happening right now too. So maybe based on this timing conversation, let's also hit on a couple of those points, because that's really important to understand, hey, and a third one even too, which is North Korea. People are always saying like, right. Oh my God, what if North Korea comes in and, all this craziness happening, how come the markets aren't reacting differently than I would have thought they would have thought? So all three examples are, whether it's taxes, North Korea, or just sort of understanding that the market's overheated, what are those different psychologies going on, and why they do or do not affect the market?
So first of all, the market is overvalued is always a discussion. So if you look at from '08 to today, that has been the discussion. Every quarter, the people who say it's overvalued today were saying it was overvalued then. Oh, it's at 10,000, but everything looks horrible. It's overvalued. It's at 15,000, but unemployment's gotten better, but it's still very high. It's overvalued. Well, now we're at 23,000. Unemployment's very low. But it's overvalued because the P ratio is high. So, look, the market's not completely stupid. It's a whole bunch of people putting their best thoughts in to price something. And as capitalists, that's what we believe. Like, you don't think you're going to walk into a neighborhood where every single house looks exactly the same and costs $300,000. You don't think you're going to buy a house for $200,000 in that neighborhood, right? The market's kind of efficient. It says if the house to the left sold yesterday for $300,000, the house to the right sold yesterday for $300,000, the house in the middle is probably going to sell for around $300,000. That's kind of how efficient markets work. Well, there is no market as efficient as the stock market, because it's all priced by the second. All the information by law has to be public and so on. So we've got a pretty efficient market we're beginning with. So how does the market why is the market priced where it is? We've got a 4P ratio of over 18, which it's true is 15% higher than normal over the last 25 years. But what's different? Unemployment is lower today than at any point in the last 25 years. Interest rates are lower than it has normally been over the last 25 years. So I like the way Warren Buffett explains it. You don't look at the price of the market in a vacuum. You look at it compared to the 10-year Treasury. And if the 10-year Treasury's around 2.5%, floating around there, and we can put together a diversified portfolio of stocks and over 10 years get 2.5%. If the market goes up zero, of course people are going to move to stocks, because the market usually goes up about 98% of the time over 10 years. So you have to look at the market compared to something, compared to interest rates, which is gives people alternative ways to invest, and you have to look at it compared to unemployment and the outlook. So the U.S. market is priced really, really well because things are really well. And overseas in international emerging markets, the value, there's more value there because it's a little rockier over there. It's just kind of that straightforward.
So I think that's a great explanation, and it helps sort of understand sort of like where the market overvaluation is or is not. I think that's helpful for people to understand that even though it may feel sometimes like things are overvalued, if you look at it in the full context of the picture, it's really not. So that sort of helps explain some of that piece. But we do know that markets go in cycles, and so one of the things we are fighting gravity a little bit here, because in a typical cyclical nature, we're ready for a downturn at some point. Now that could be tomorrow, or that could be a year from tomorrow, or 3 years from tomorrow. But the point is the market will eventually correct. It must, because what goes up must come down. That's the way that the market works. So the question is, how can people protect some of that downside risk that they're looking at, or what can they do when that sort of drop happens to make sure that they don't memorialize their losses and basically lose everything and all the momentum they just gained?
Well, I think that the market going up and down, I would maybe reframe that a little bit. It does go up and down, but the market really goes up in cycles. And so the market is not going up and then down and up and then down. It's going up like this. And I think that most people don't understand that. Like, oh, it went up, it has to come down. It does not have to come down. It can come down a little bit and temporarily. So it can go from 10 to 23, and then it can go down to 20, and then it can go on to 25, and it can go down to 17. But it is heading in a certain direction. I would look at it like a Hershey's bar. You know, the prices used to be 5 cents, then 10, then 20. Now it's $1. Well, somewhere along the way, they were discounted, right? Instead of being $1, you might go to the store, they're 90 cents. No, none of us think that a Hershey's bar is going to be 90 cents 10 years from now. We expect it to move up over time. Yeah, there might be these periods where they can't raise prices and they even have to cut prices. But over time, the Hershey's bar is going to cost more. It's the same thing with the market. So the other thing I would say is corrections, while they happen on average every year. So a normal definition of a correction is a market drop of 10% or more. And the average correction is about 13.5%. Now, think about that from these levels, because the points on the Dow at around 23,500, everybody is going to completely freak out when we have the next correction. You know, when the Dow was at 10 and it went down 1,000 points, people would freak out then. Now we're talking about almost 24,000. The next correction could be 3,000 points. Everyone's going to lose their minds. You know, the financial media is going to get everybody in a tizzy and everyone will go crazy because it will be thousands of points. That would be a normal event that happens on average every year. But it doesn't have to happen every year. Sometimes we go 4 or 5 years without a correction. Sometimes we have 5 corrections in 1 year. So it doesn't say, oh, I went up for a long time, I got to come down. But corrections sometimes happen for no reason. Sometimes the market takes a breather. There's just psychological short-term deal. But over the long run, the bear markets, which is what we're really concerned about, the ones that are 20%, which the average bear market might be 34% or more, those really, we need to have a reason. You know, we need to have a reason. And it's hard to look at the landscape and see that reason today. You don't have recessions, accompany unemployment like this and low interest rates like this. And so it's hard to see a really negative picture outside of war or terrorism or one of those anything can happen type deals. But when you get that pullback, that's the opportunity. When you hear people say, "Oh, I lost everything or I never recovered," they exited at the wrong time. That you really have a great investor when they see a correction or a bear market and they go, "What I liked at $50, I love when it's on sale at $40." So the stock market's the one thing nobody wants to buy when it's on sale. If you like Apple today, if it's 25% less for no reason, because we have just a broad-based pullback, you should be looking at that as a buying opportunity. And those are, I think, the really great investors, the ones that exploit the down markets.
So I think that's great insight. The other part that I think people get concerned about is, okay, so let's say I do all these things that are right. I still have a concern about the fact that there's this Equifax breach that basically then says, okay, now my actual personally identifiable information is now on the public market. So, one of the things that I really love about what your firm does is you're looking at the holistic strategy for investors. And so one of them is, in fact, that somebody could come in there and try to pretend that they're you and then do a whole bunch of things that you don't want. So your advice to investors, if I remember correctly, was to freeze their credit. Talk to me about why it's so important for someone to freeze their credit if they've been part of this, well, even if they haven't, but just based on the fact that there's 1 in 3 Americans has their personally identifiable information out on the market today because of Equifax.
Yeah, I would say that if it wasn't Equifax, it was going to be somebody else. And we already had Home Depot, we had Target. It's just on and on and on. Now, I think if you're somebody that accesses your credit all the time, I wouldn't freeze it. Yeah. So a business owner that's accessing it all the time or somebody that for whatever reason is having to borrow all the time, probably not worth the hassle. But to the extent, and I'm pretty radical about this, to the extent you don't need any accounts, you should close them. So go from 10 bank accounts to 1 or 2. Do you really need to get a credit card every time you go to the Gap or Banana Republic or Macy's? Close out all of those credit cards. you want to look at all of these various things as entry points for somebody to steal your information. So ask yourself how many entry points you have and how many of these doors do I need to have? Keeping all of these doors locked and secure and tight is a very difficult thing that you can't really control. You can do certain things, passwords and so on, but at the end of the day, we also have the provider with that information. So the less places that have that information, I would say for your readers and viewers, the better.
So I think that's great advice, and I think the other piece of this too is that if you're looking at sort of someone who doesn't necessarily need to open up a new credit account,
Right.
whether that's a home equity line of credit or credit cards or things like that, your advice was to actually freeze your credit. Talk to me about why the difference between freezing versus monitoring, because I think a lot of people think, well, I'm not have to worry about that because I got LifeLock, and they're going to basically
Right.
tell me if somebody messes with my credit. Tell me the difference, because I think it's really important.
Well, I think if somebody's monitoring your credit, they're telling you after or if something has happened that's suspicious. And, at that point, now we're trying to fix all this. And look, LifeLock's not a bad thing, but your life is going to be pretty miserable if somebody steals your identity. So if you freeze your credit, no one can take your information and go open an account because the credit agency is basically closed to them unless you unfreeze it. That's a much, much stronger protection. That's an actual real barrier. So, the two best things someone can do if they're really concerned about protecting things is to freeze your credit and to not have as many accounts out there. And then the third thing would be to control your social media. How much information is out there? Can people piece together your birthday and your social security number and your address and where you go on vacation, all from just following you on Facebook? If so, you're really giving people a lot of information to access all these doors. But freezing the credit's a very big step to eliminating a lot of problems.
So, Peter, you're a total wealth of information, and I want to talk to, there's a couple other things that I want to make sure we touch on, but before we do, I just want to know, is there anything that we haven't touched on so far right now that you think of that is really important for this audience to hear and understand? Because you're on top of a lot of these things, and you have access to insights that a lot of people don't even have. So we've had a lot of good conversation so far. Are there points that you still want to drive home or things we haven't touched on enough?
I would say, I'd go back to, because the thing that I see where I see the average American make the most mistakes is getting caught up in politics. And it's fine to be caught up in politics, but bringing it into the investment world. And I think that people really need to understand that the president of the United States does not impact the economy that much. And if you look historically, it's really very much driven by demographics, unemployment, interest rates, and so on. Yes, things like tax policy matter. So, let's take, for example, the last 9 months, whether you're Republican or Democrat. If you look at the last 9 months, the Republicans would say, well, look, Trump, the economy's great under Trump. And if you're a Democrat, you might say, well, it was, the market went straight up during the entire Obama administration. It went from, 8,000 or something like that all the way up to 20,000 or wherever it was when the baton was handed off. Unemployment went from 10 down to 4.8, I think, when Trump took over. Now it's 4.2. So it's done well under both. It's really not driven, and it's done poorly in the past under both. If you look at the tax cuts, for example, the U.S. market likes that. So the U.S. stock market, obviously, if you say, hey, these corporations, instead of paying 30 plus in taxes, they're going to pay 20%. Well, they now have more money that flows through the shareholders. So there is a piece of the U.S. market's 16% year-to-date return that is because the stock market thinks there will probably be a tax break going forward. But most of the return has nothing to do with that. If you look at the United States year-to-date, actually, this is the first year in many years the United States has underperformed almost every market in the world, which Trump has nothing to do with. Trump has nothing to do with the emerging markets and the international markets and so on. Those markets are outperforming the United States. So I think if investors can pick up their cable news out of their heads, whether they're Democrats or Republicans, and say, look, this stuff it does not matter that much. The market also doesn't care. The second thing I hear most from folks is, well, but there's terrorism and there's protests. And if you look at something like, say, North Korea, which some people want to cash over, the market doesn't look at a low probability. Yes, they go, well, that would be horrible. But if the odds of it are 1 in 1,000, which is how the market sees it, the market ignores it. Right?
Well, and more importantly, if that one thing does happen and we actually have a nuclear war, then really the markets are irrelevant at that point anyway. So on both sides, it doesn't matter.
Yeah, pleasant all the way around. So I just think that the intensity of the polarization has actually, you combine this constant news with the intensity of polarization, and people are making investment decisions that are harmful. It doesn't matter what side of the aisle they're on. They're making investment decisions that are harmful to their ability to achieve financial success. They go to work all week, maybe 50 hours a week. A lot of people, 60, 70 hours a week. They put all their money in a basket. They hand it to somebody who doesn't have to act in their best interest, that maybe sells their own products, maybe selling variable annuities. Then they're panicking based on who's president or not president, and they're going to cash. And you spend all this time earning it, and you make 1 or 2 mistakes, and it's not going to work out. You have to be in the game and stay in the game with the right people to really have a shot at making it to the end zone.
That's awesome. Well, Peter, I really, really appreciate your time today. I think you are an absolute wealth of insights, and I am really, really happy with all the work that you're doing. I think your team at Creative Planning is amazing. I think that the insights you provided to Tony Robbins in both of his books, Money Master the Game and Unshakable, were great. Your 5 Mistakes Every Investor Makes is another fantastic read that people should be reading so they understand what happens when they panic and sort of go into these things, as opposed to what smart investors do. I think you have a lot of great things to share. So thank you so much for taking your time today and being on the program.
I appreciate it. I enjoyed it. Have a good day.
Take care.